Welcome to today's Financial Explainer. We're putting on our anchor hats today to unpack a highly anticipated and honestly closely watched piece of communication in the mutual fund space. We're diving right into Rajeev Thakkar's August 4th, 2026 note to Parag Parikh Flexi Cab unit holders. Look, if you follow the markets, you know this fund has an absolutely massive footprint. When they speak, the street listens. So we're going to break down the exact path they're charting to see how they're positioning for a return to value.
Let's start right at the top. When you open a note from a heavyweight fund manager after a pretty challenging stretch in a volatile market, you'd probably expect a pivot, right? A new strategy, maybe a defensive rotation. But instead, we get this incredibly blunt, punchy core message: nothing changes. It's a fierce defense of the PPFAS investment philosophy rather than a shift in strategy.
But this immediately brings up the tough question on literally every retail investor's mind right now. Why on earth would a fund manager double down and say nothing changes after roughly 2 years of sideways, relatively weak performance? Well, to understand why this isn't just stubbornness, but actually a highly calculated setup for future growth, we really need to look at the data.
Here's our starting bell rundown for this explainer. 1. The message: nothing changes. 2. A flashback to 2024 valuation warnings. 3. Facing short-term underperformance. 4. Debunking the AUM myth. And finally, 5. The improving market outlook.
Okay, Section 1, the message: nothing changes, and specifically, why equity markets just don't move in a straight line.
So, enter the concept of a time correction. Thakkar argues that this recent 2-year flatline isn't a systemic crisis. It's not some extraordinary black swan event. It's actually completely normal market behavior. It's really just the market taking a breather, allowing corporate earnings to catch up to stock prices. We've got to translate this vital market reality so everyday investors realize this sideways action is a natural, totally necessary cycle, not a failure.
Moving to Section 2, a flashback to 2024 valuation warnings and the tough battle of being cautious when others were being greedy.
Let's rewind the tape a bit. Back in 2024, we saw widespread market exuberance. Valuations were incredibly stretched, and people were chasing returns like crazy. But during that exact same period of excess, the PPFAS team decided to play defense. They repeatedly urged caution, they deliberately maintained higher cash levels, and listen, this wasn't an accident, it was a very tactical move. And as a result? Well, they faced heavy criticism at the time for sitting on all that cash while the rest of the market was seemingly just printing money. Which brings us to Section 3, facing short-term underperformance, and exactly why contrarian investing demands so much patience. Here is the stark reality of their portfolio style. It's heavily focused on contrarian, out-of-favor opportunities. They frequently invest in stocks and sectors that literally no one else wants at the moment. And Thakkar makes it very clear in his note that when you deploy this specific strategy, there are going to be inevitable periods where the portfolio falls, moves sideways, or underperforms the benchmark. It is quite literally baked into the philosophy. But the crucial takeaway is this. Thakkar states that this current underperformance is neither unusually long nor unusually large. That is, provided you're viewing it through the lens of a full market cycle. This right here is the key reassurance for mutual fund holders. When you zoom out from the daily ticker tape and look at the macro picture, this current dip is standard operating procedure for their style of value investing.
All right, Section 4, debunking the AUM myth. Is the fund too big to succeed?
Thakkar pushes back hard against the argument that massive assets under management is their primary problem right now, and the historical tape absolutely proves it. Back in 2007, managing a tiny portfolio management service with roughly 100 crore rupees, they experienced substantially larger underperformance. Compare that to 2026 with a massive AUM where they're just seeing normal cyclical underperformance. This data definitively makes the case that managing a mountain of cash isn't the root cause of their current lag.
Finally, Section 5, the improving market outlook, and why this setup is getting so much better.
This is the absolute most critical shift in the entire August 2026 note. Thakkar's overall stance is now becoming much more constructive on future prospective returns. Why? Well, 3 specific catalysts. First, that 2-year time correction we discussed, it's largely complete. Second, the price correction has worked its magic. Expensive and overheated segments of the market have finally cooled down. And third, because of those 2 factors, there's now an increasing availability of attractive opportunities. The very excesses they warned about in 2024 have completely washed out, significantly improving the opportunity set today.
So what does all this mean for you, the investor? Here is the bottom line. This is emphatically not a things are going badly letter. It's a stay patient, the setup is getting better letter. If you're a long-term investor evaluating your portfolio, wondering if you should continue your systematic investment plans, your SIPs, or even increase your allocation, this note provides a really strong argument for staying disciplined. Keep in mind, Thakkar doesn't guarantee near-term outperformance or overnight returns, but the shift from caution in 2024 to constructive optimism today is a massive takeaway.
I want to leave you with this final, provocative thought, directly inspired by Thakkar's note to test your long-term investing resolve. Think about it. If equity returns were entirely predictable and guaranteed every 3 to 12 months, why would anyone ever take the lower yield of a fixed deposit? There'd be zero risk premium. The sideways periods, the underperformance, the waiting, that is literally the price of admission for long-term equity wealth. The setup is improving, but the real question remains, are you patient enough to reap the rewards? Thanks for joining me on this explainer, and remember to keep your focus on the long game.